I'm going to say that investors from the most sophisticated down to the most novice who's starting to learn today, there are many companies that you interact with on a daily basis that actually adhere to these principles of dividend growth.
This episode is sponsored by Saxo Markets. Welcome to the Investing Insiders podcast, where we help you achieve financial well-being by making smarter money decisions. I'm Brianne.
And I'm Antonia.
And in this episode, we'll be learning more about dividend investing, how it works, and whether it's something you should consider. Joining us today is Jonathan Nurick, the Chief Investment Officer and founder of DivGrow. Jonathan, welcome.
Thank you. Nice to be on the show. Nice to meet you, Brianne and Antonia.
Yeah, we're really excited to dig into today's topic. But I guess before we dive in, it'll be great to get an overview from you about how dividend investing works and who it might be best suited for.
I'm going to segment dividend investing into two separate subcomponents, but maybe as just an initial overlay, let's first describe what a dividend is for the audience. And a dividend is a payment that a company can choose to make with the profit that it has available. So when it finishes its period or its year, and hopefully it made a healthy profit, and hopefully it advanced from last year, it has a few options at its disposal. It can reinvest in the business, buy machinery, invest in more people, employees, etc. It can pay down some debt. If it has any, it can buy another company. It can buy its own stock back, and it can also pay a dividend. And so a dividend goes out to the shareholders, and it's a share of the profits. Now, most people who hear dividend, their first question is how much? And that's a natural question, and it might be the right question. Most investors think of dividends as income I can have today. But at DivGrow, what we're trying to do is actually ask the next question, which we think is a more enlightened question, which is how much does this dividend become over time? Because the safest dividend is one that is growing quickly, and the faster it's growing, the safer it is. So dividend investing is being interested in the receipt of a share of this profit from the company, but we're going to divide it into two sections of trying to maximize for today versus trying to maximize for the future.
Okay, so I mean, in its simplest terms, I suppose a lot of investors use dividends as an income when they're investing. So, you know, some companies will pay out a monthly dividend and people will invest a certain amount and they'll live off, or they'll use it as a supplement income to what they already have. So your proposition is that you're suggesting that people don't use it as an income. Is that right?
I'm not trying to fault people who choose to use it as an income. And of course, some people's circumstances will be such that they have to be able to use their investable dollars to be able to create a reasonable income today because of bills and commitments and things like that. However, for those who have a longer horizon, dividend growth investing, I'm slotting in that word growth in there, is let's call it enlightened version of doing the same thing if you have a longer time horizon. And to make it almost very familiar, there's always a trade-off in almost every decision that a person makes, investing or otherwise, between optimizing for now or optimizing for even more later. So let's take the example of when somebody is trying to lose weight, get fit, something like that. In a sense, every day, every meal, they have an option. They can lie on the couch and watch Netflix. That's completely fine. They'll enjoy it now. That's like a big dividend today. Or alternatively, they can turn off the TV, go for a run, hit the gym, make it better for tomorrow. And those decisions compound. Same with the burger versus the broccoli. And in any given period, it might be hard to notice the difference. But if you stack them time after time after time of choosing the broccoli or choosing the gym, the result that ends up at the end of that compounding streak is immensely different. And coming back to this concept of dividend growth investing, you can say to yourself, what will pay me the most today? What has the highest yield today? Typically being priced by the market with a high yield because there isn't an expectation that those dividends are going to grow. We can get to that. Or alternatively, you can look for a dividend growth company where what you get today might be modest, but there is an expectation that what you will receive will grow at a high rate and become an immense amount of cash flow down the line, which is that compounding in action. And that's really the area where we focus.
So looking at the sort of time horizon, what period do you have as a benchmark, number one? And when looking at these growth companies, what are the characteristics that would signify that a company is going to have that growth later down the line?
So the shorthand would be that the longer the better. When you have something wonderful that is working in your favor, like compounding, you can play around with with Excel or even on your phone, and you can see that the heavy lifting of compounding happens in the outer years, however you describe it. We at DivGrow take a career-long approach. We opened the fund on my 30th birthday, and the idea was to take a 30-year horizon because that was my age to that point. And simplistically thinking, what if we aspire to take each one of our dollars, turn it into 30 over that time frame? Now, because the nature of compounding, a lot of the compounding is actually back-ended, where if something continues to double, there's the example, for example, of, if you could have $1 million today, or otherwise, a dollar that compounds at doubles every day for a month, you should go for that, because on the last day, the inflection is so big in the month that you get an infinite number of dollars by comparison. And so what we're looking for are companies that are overlooked for their dividend paying characteristics, notwithstanding the fact that some of them have paid dividends, rising dividends every year for a very long time. And we are saying to ourselves, can this dividend stream become bigger at a rate of 12, 13, 14, 15% per year for a long time? It might not be every year 12, 12, 12, 12, 12, because business is dynamic out there. Sometimes you have to invest a little bit more. Sometimes business goes a little bit better, a little bit faster. But over time, can you get to that healthy double digit or healthy low to mid-teen rates of dividend growth? Because ultimately that produces a very healthy rate of cash flow appreciation. And with it is an idea that the capital, the share price, should follow the dividend over time. It makes a lot of sense that if you ask yourself, I have an asset, it can be a stock, which we're talking about now, but it can otherwise be an apartment. And if I get my rent and I have a good tenant and I think that I'll get paid and I am able to hike the rent at a certain rate, if I come to sell that apartment, the first question that somebody's going to ask is, what's the rent? What are the prospects for the rent? And if somebody's trying to go next level and they say, how close is it to a train? Or did they build a good new school nearby? Really what they're asking, how is the rent going to develop over the next 5, 10, or 15 years? Because the price will follow the rent. And in our case, we believe, and there is loads of academic testing all the way back to the 1950s, where Professor Myron Gordon at MIT sort of demonstrated this relationship, that where the dividend goes, ultimately the share price follows. So we're trying to optimize for fast dividend growth over a very long horizon.
That makes sense. I like your rent analogy there, because that sort of helps to simplify it. It is quite a tricky subject. I think I'd just like to ask you, when discussing dividends, yield obviously grabs a lot of attention from people, but how do you think that people should separate dividend yield from dividend growth?
It's a dynamic trade-off. In generally speaking, the higher the yield, the more the market is telling you today that there are question marks about the prospects for this dividend. So if you find something that is trading with a yield of 5, 6, or 7% and you look at the history of that dividend over the last few years, more often than not, because there can be outliers, there can be a company that is just completely misunderstood by the market for a while. Ultimately, the market figures it out. But if you look back at the last few years, typically when the yield is very high, you will also see that the dividend hasn't grown. Perhaps it has even been shrinking. Now, let's flip that. If you have the luxury of time on your side and you don't need to spend that money now, then The inverse is often true. Companies that have a low yield, 1%, 0.5%, but is growing at 12 or 15 or 20% per year, if you believe, because of what you think this company is doing, that can happen for a long time and grow every year at 15 or 20%, put that into your calculator and you will find that your 0.5% yield today, after a few years, it's 1%. A few years later, it's 2%. A few years later, extend that, and you are getting a torrent of income, and the share price has gone with it. So your total solution ends up being a much better outcome, but you had to be willing to wait to get there.
Which is true of all investing. It rewards patience. But I mean, there's a lot of quite sort of complex terminology to consider here. And what I'm wondering is, do you feel that this kind of investing is accessible to normal retail investors who've got, just sort of average knowledge, probably might, understand about index funds or stocks and things like that, but haven't really considered about this sort of investing before with dividend growth?
So Peter Lynch, who was one of the great investors of the 80s and early 90s, in his book, One Up on Wall Street, which is a worthwhile read for anybody who's trying to learn in the space and really written to be understandable, he would say, go to the mall. And this was before internet shopping. He would say, go to the mall, and where there's a store that you think you have a good understanding of the merchandise and you see the queue and you understand what kids are wearing at school, and try and triangulate that in your mind, and maybe there's an investment there. And I'm going to say essentially the same thing. I'm going to say that investors, from the most sophisticated down to the most novice who's starting to learn today, there are many companies that you interact with on a daily basis that actually adhere to these principles of dividend growth. So whether you pay every day for your coffee or your train with a Visa or a MasterCard, it so happens that MasterCard, since its 2006 IPO, has grown its dividend every single year. And Visa has grown its dividend every year since 2008 IPO, every single year. And both of them have been growing their dividend in the order of 19% per year since then. So while the yield started low, if you said to yourself, and again, I'm simplifying, but if you said to yourself, this money is moving from cash towards digital forms of payment, it seems that everybody I see out there is using these cards rather than others, more often than not. Is that likely to continue? Are more banks issuing these? Are there more use cases? Is commerce likely to continue? Is there a long runway from cash to digital? If the answer is yes, 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 maybe you can start to learn about these businesses. Now, the intricacies of the business itself is a little bit complicated, but simplistically, you could go onto Google or today into ChatGPT and ask for the history of the dividend of the company that you're looking at exploring. And if you see that it was $1 and then $1.20 and then $1.45 and then $1.60 and then $2, it might be a good place to look.
It does sound like there's a lot of context, I guess, around the companies that you look at, I guess, with any kind of investment that you decide to consider. I suppose one of the things that does come up a lot, particularly with beginner investors, is the idea of making sure you have a well-rounded group of assets to balance each other out over a period of time. When looking at dividend, be it growth or yield, how does diversification factor into that, and how much of a mix should people consider when looking at it?
So we try and build a portfolio that is nicely diversified across various industries. And if you're looking for dividends, especially dividend growth companies, you can find them in lots of areas. And we own healthcare, but the idea is that it's critical healthcare, things that people need and can't switch off. Because if they can switch them off, well, then the business may have a gap in its sales that year, and then the dividend might not grow. It might even not grow or get cut, and that would be a disaster for this kind of principled investing. We look for critical business services. We look for specialty distribution. So our largest holding today is a distributor of air conditioning components. To simplify, again, we believe that most people who enjoy being in air conditioning, whether this in their home or in their workplace, if it stops working, it's somewhat of an emergency. Or they're going to treat it as such. And so if you are the largest distributor and you're able to get the product to the technician fastest, best terms, broadest inventory, you have an edge there. And air conditioning is becoming more ubiquitous. And we know from having studied this for a long time, just how long it takes air conditioners on average with every age to decay and need to be replaced. We spoke about payments before. There are companies that people deal with every day in pest control and uniform solutions. It doesn't have to be the absolute cutting edge, which is hard to understand technology. The only area where we haven't been able to find what we're looking for are things that are very sensitive to the price of something outside of their control. So we don't invest in minerals, resources, shipping, because there's a price that is set by market forces that our company or any company in that space can't control. And when the price goes up, they make lots of money, dividends go up. And when the price goes down, they don't make lots of money. Sometimes they lose money, and then the dividends go down or disappear altogether. So predictability, and something that has an evergreen critical need that a business or a person is never going to go without, that's the area where we like to look.
Okay, so I've got a couple of questions. I'm going to ask them to you at once so that you can sort of respond holistically. So presumably, a lot of what you're talking about is you're talking about dividends on individual stocks. Can this sort of dividend growth method be accessed within a fund? Because if you're talking about individual stocks, then you're sort of skirting on stock picking, and stock picking isn't usually suitable for someone who's a complete beginner. If someone was a complete beginner to investing, we would usually sort of point them towards a fund and go, okay, go and get into that fund because that's all just been diversified nicely for you. And that's going to take some of that stock picking risk out of the equation. So is it the case that there are a group of people that this would be unsuitable for? Or is it the case that group of people would look to invest in dividend growth via a ready-made portfolio, such as, I think that's what you're referring to?
So that's a lot of good questions. And on the one hand, yes, we DivGrow. The reason why we called ourselves DivGrow is because we operate funds that do just that. They look for companies that are able to grow their dividend at a very rapid pace, and we've been pretty successful at doing that. Now, one can go down the route of an ETF or an index fund, and you're absolutely right. For a lot of people, especially when they're starting out, that is a very suitable solution, at least for part of their money, because they get a broad basket of all sorts of things. And one could try and build the right exposures. There's just one thing that I think, as good as index products are, there's an element in them that perhaps overlooks the psychological part. And that is to be able to get to those outer years of the compounding curve, whether that is in an individual company or an index, one needs to be able to withstand from time to time bouts of volatility. And bouts of volatility don't feel that great. It's sort of a visceral thing in the gut rather than an intellectual pursuit. That's why Warren Buffett says that investing isn't won by the most intelligent with the highest IQ. It's won by somebody with a sound intellect, a sound methodology, but who has the strongest gut or emotional framework to deal with what gets thrown at them every day. And I don't want to say anything negative about an index fund, absolutely, because they are very good for lots of purposes. But what they don't provide is any kind of emotional bolstering, because you basically have a number which traverses up and to the right over time. And every so often, it can have a sharp move up, which might feel nice, but a sharp move down. And it may or may not be easy to explain or to understand. There might not be a very good explanation. Now, on the company specifics, while it does require more work to go and choose your companies and understand them, what you do have is a feedback mechanism attached to a story that you have got involved in. So whether that is following payments, you can look around and see who's paying with what, or whether that is renewing your pest control solution every year, you can look to each one of those companies' dividends, which in the United States, which is where most of our companies are paid quarterly and raised every year. And you can see, notwithstanding what the price has done, because sometimes it will move erratically, if the dividend went up at a reasonable pace, 10%, 12%, 15%, you can say to yourself, there's only really one way a company can keep doing this. And that's because it's becoming stronger, more productive, more profitable. So you have this very valuable emotional crutch to lean on, which isn't available in an index or an ETF. Whereas in the company context, you have a data point, which is, how is this dividend going? We talk about the concept of a staircase, a dividend that we chart the payments like this, up and to the right, up and to the right, up and to the right. The share price traverses the same direction, but it goes around it like a roller coaster, sometimes rapidly above that number, sometimes a bit below that number. And over time, they end up at the same place because dividend and price is connected over time. And if you compare that to a ETF or an index product, all you have to go by is the price, because there's complex methodologies underneath. And our contention, actually the data supports that people hold those instruments for shorter. Now, if they move from that to something better, that's fantastic. But again, the data doesn't support that to be true. They typically support that people hold that until there's some kind of reckoning. They exit, usually when things are moving against them. And it's a long time before they're able to kind of muster their emotional courage to step back in, and that breaks down the compounding curve.
This episode of the Investing Insiders podcast is sponsored by Saxo Markets. Saxo provides access to a broad range of global assets through a sophisticated trading platform. You can trade US stocks from as little as $1 per trade and UK stocks from $3 per trade. Please remember that all investing involves risk. The value of your investments can go down as well as up, and you could get back less than you invest. Terms and conditions apply. Visit Saxo Markets to learn more. I think that's a really interesting point as well, especially looking at the psychological aspect. It is something that, particularly if you're a beginner, you do need to be prepared to weather the ups and downs of the performance of your portfolio. I suppose looking at dividends, and it was quite interesting to get the sort of staircase imagery. At what point do you start questioning the performance of something? And are there any red flags that people should look out for when it does come to, growth or yield that would signify it might be time to make a change?
Very good question. And there's a lot to unpack in there. Like I mentioned before, business is dynamic. So even though we would love it if our companies committed to raising their dividend at our required rate, 12% a year, even if they sort of can, it is exceedingly rare for a company to be that metronomic, though they do exist. But they're true outliers. But what we want to see is over a reasonable period of time, say 3 or 5 year periods, that the dividend is increasing every year because the company is becoming better and more productive. But from time to time, they might need to invest more in a product, or they might buy another company to reposition the business. And what we want to see is a good reason why a dividend is not increasing at the pace that we demand, which is that low to mid-teen rate. And so what we want to see is that the company over a 3 or 5 year period is sustaining that rate on average. So if there's a big acquisition that they need to make, instead of raising their dividend by 12%, maybe they raise it by 5%. But by the next year, it's back to 10, and the year after that, now they're repositioned 20. You blend those numbers, you get a healthy rate. And the red flag would be if the dividend is not keeping pace and there isn't a good reason that you can understand. It is not clear to you, and therefore there's some kind of potential problem on the horizon. If the competitive dynamics in the environment, in the business environment, are changing, all of a sudden there are loads of competitors, or the whole product is changing too dramatically, or the geographic positioning of the business has changed, then there's a lot of revisiting that needs to take place. Now, those companies that adhere to dividend growth investment best, they're extremely proud of their dividend credentials, as we call them. And if you just go and look at their announcement when they either file their annual report or when they announce their dividend increase, they make a big song and dance about it. And they say things like, today, our board is proud to announce that we have raised the dividend by 15% from, say, $1 to $1.15. We are doing this because the business continues to get stronger, and we have been able to do this for X years in a row. And in some cases, X is 40 or 50 or 60 years.
So am I right in understanding that this type of investing can help to smooth out the volatility and therefore could be a good option for investors who are more risk adverse?
So it happens to be the case that these companies tend to be higher quality than average because they have a dominant position in something critical that doesn't go away. They enjoy things like pricing power and a steady customer base, etc. They tend to also not need or use much debt. So when the market is in a, let's call it a difficult patch, they tend to, but this is not true all the time. It's true much of the time. They tend to fall by a little bit less, and that is emotionally valuable. However, because they tend to be boring companies, they are not trying to do something that is, so out there technologically. They are doing things that need to be done that are very important, that the customer has a high degree of trust and doesn't look or doesn't want to go elsewhere. They often get overlooked by the market. And because they're overlooked by the market, they're not necessarily appropriately priced. And because they're able to grow at a healthy rate in what feels like near perpetuity, if they're able to grow their dividend for 40 or 50 or 60 years at a high rate, they tend to be systematically underpriced. So their returns don't have to be any worse than any other category, but the experience from a drawdown standpoint is often better, but that's not true all of the time. And from an emotional standpoint, because they're giving you something to hold on to, they're giving you a real tangible proxy, which if you receive that money, you can receive it in your pocket. That's very tactile feedback. It helps you stay the course when things feel a bit uncomfortable, when the newspaper is uncomfortable, when your friends are talking, when the business media feels like it's telling you like the world is going to end, which sometimes happens. Not the world ending. Sometimes the media runs with stories that go down that line.
There's definitely, I think, a lot, that comes up, and it definitely can affect your perspective. I think what would be really interesting to hear is, what was your journey into dividend growth and making it such a formal part of your, investment strategy? And as you were getting into it as a beginner, what kind of steps did you take to get there, and how would you lay it out for somebody that's completely new but might be interested at this point to kind of try and give it a go?
In a sense, I was fortunate to come into this space. My father had founded a hedge fund business that was ultimately very successful, and I kind of wanted to emulate. But after selling his business and beginning our family office, I had spent a short career in law and investment banking, and then I came into the family office. And he dumped on me what I considered an intern's job. And I felt overqualified for the intern's job, but it was a very formative, valuable experience. Every day we would get the mail. And the mail was a pile this thick of envelopes. And in it were dividend statements for various companies, for various entities, from various banks or institutions where we held the securities. And so one by one by one, I open these envelopes, tick that the dividend was received. Yes, that's good. Compare it to the same time last year. Is it higher by 10, by 12, by 15, by 20%? Good. Why? Next envelope. A dozen envelopes a day for a month, for a quarter, for a year. And you begin to learn that the company is sending you a message in cash, in a statement. Now, today, many people might get it electronically. It's sending you in almost a secret language this idea that the company is flourishing. All is well. We have been able to grow our profit at a very healthy rate, and that is why we are growing our dividend at a very healthy rate. And now, it took me a long time to appreciate that what felt like an intern's job was such valuable education from an emotional standpoint. Everybody wants to get on the desk and start crunching numbers to find the best idea that will go up the most tomorrow. But beginning with psychology, with emotion, building the framework of how I'm going to stay the course as an investor is a far better beginning than trying on day one to find the single best strategy that will deliver the single best return today. Because even if you happen to, which is relatively unlikely, find the single best stock that will go up the most, almost inevitably there will be periods when it will underperform for a quarter, or there'll be a news article that is not great and the price will fall and your emotional framework will be tested. And if you haven't thought in advance how I'm going to deal with that emotion, you are ill-equipped to carry on. It's no different, coming back to what we spoke about earlier. If somebody's trying to get fit, lose weight, a lot of people will say, hire a coach. Because when the coach is there to keep you accountable at 5 o'clock in the morning, to take you for a run, to take you to the gym, they are telling you you're progressing. Often, the gym is full in January and empty by April. And the reason why that is yes, it is hard, but the gap between the feedback of how I'm progressing relative to my effort is just too long for a lot of people to withstand if they hadn't thought in advance, how long am I going to persist and what feedback do I need along the way? And we believe that if you do that with dividends, if you build your emotional framework in advance, what do I need to see to make me feel right? Forget the price will work if the dividend will work over a long enough horizon. But I need to think that in advance, because if I think about it on the fly, it's too late.
Absolutely. I guess, kind of digging into that a bit more, when it does come to this, how much planning is too much planning, I guess? Like, can you get stuck in the weeds of researching things too much that you never take that first step? At what point do you think is the sweet spot for saying, okay, I've done enough research, it's time to, get into the field and see how this goes?
Let's answer that in two ways. Yes, you can be very informed. In most businesses, there are only a handful of things that really matter that are going to drive this. And I'll give you an example. But the counter argument is there are businesses we have been studying all the time for 20 years, and we're still learning about them because business is sort of dynamic. It develops, it goes into new territories, brings out more products. The CEO may change, the board members may change. So I know that those are two kind of polar opposites of an answer. But when we build an investment case, we're asking what needs to continue to be true for the thesis to hold up. Our preferred framework is actually that something is the price leader, meaning it can price below anybody else in the market, because fundamentally people like things that are cheaper than others, except say for the category of Veblen goods, where the more expensive they are, the more people want them, like an Hermes bag or a Lamborghini. But most of our companies, ideally, even if they don't price at the bottom, they're able to price at the bottom. They got the sharpest cost curve. And the second part is, does this company provide a good or a service that the market needs, and that's going to continue to be true for a very long time. So I mentioned before, say, pests, right? Pests are a fact of life. They exist out there. Nobody likes them in their house, and there's a certain amount of treatment that one can do. And if somebody can reliably deliver a good service, show up on time, put safe products in there, and is willing or able to price at the best equation of either absolutely the lowest price or the lowest price relative to the value delivered, because it might be a higher touch, superior product, then as long as those two things are true, a lot of things may change. The CEO may change, and we're going to have to do quite a lot of research into the person, but the underlying idea continues to be true. So yes, somebody can theoretically go and study for decades the same company to learn and never make their move. But ideally, one can isolate those few things. It's only a handful. You should be able to write the idea down in a quarter of a page, 3 or 4 bullet points, that if they are clear enough, true enough, persistent enough, and you have a basket of those, you should be okay over time.
Okay, so this is all super interesting. I worry for people. Like I feel that there might be a lot of people listening who are kind of suffering from paralysis of choice, and I think that that's a common issue for people who are investing just ordinarily. This is what we hear a lot from people who are trying to get started. They're like, I just want someone to tell me what to do. I don't have the time or the inclination to study the form myself and find out where to go with it. What's your suggestion for that group?
So you actually wrote an interesting piece about the difference between investors, or what were so-called investors in the UK versus in the United States. In the United States, most people own stock. I think the number was 6 out of 10. Correct me if I'm wrong.
Yeah, and I think I referenced Australia in that as well.
You did, and the superannuation system, which in a sense forces people, the moment they begin work, forces them to become an investor. Unfortunately, many people are not that engaged with it either.
Yeah, I mean, in the UK, we're really sluggish, but I mean, I think it's almost a product of all of the risk warnings that people see, and they're afraid of making the wrong choice, and there's all of this messaging: you could lose all your money, and yeah, of course that is a possibility, but you'd have to make some really bum decisions for that to happen. So yeah, carry on.
There can be this decision fatigue of there are too many options. So what do I do? And can somebody do it for me? In a sense, all you're doing is changing the decision, but there's the same problem of how do I choose the right person? If instead of being a stock picker, you now have to become a selector of funds or selector of advisors, which is no easier, and perhaps might even be a more concentrated risk, because you might only choose one or a handful. So my personal belief is there is no alternative to trying to educate yourself. On the plus side, there are more resources, and it is easier to begin the process than ever before. Just hop onto your preferred AI model, Gemini, GPT, whatever you like. Literally start asking your questions. And in the prompts, you can discuss a company. Now, don't necessarily rely on everything that it says, but if you're learning about ideas, then it's a very good place to start. I would also encourage people, if there's a company that they use their product frequently and they think they understand, and everybody understands something because everybody works in something, to be able to even have the funds available to invest. Therefore, they have a lot of knowledge about a space. It doesn't matter what it is. It can be in a media business, it can be in a healthcare business, it can be in a cosmetics business. And I mean, the facts are we happen to own L'Oreal, and we know that about 1 in 4 people today touched a L'Oreal product. So a lot of those people can begin the process of learning about the company because they already know the product. So there isn't a substitute for learning. And if you subcontract the learning to somebody else, I believe that the emotional component will be even harder because, again, we are getting this direct, not so secret or open secret communication from each one of our companies when they're sending us this dividend information. But if you now are going through an advisor, an index, a fund, you may or may not have that kind of information flow that has been designed for your understanding. The dividend is just one number. It's X dollars per share, or X cents per share, or X pence per share. And that is a very easy thing to get on top of, rather than having to become a selector of fund managers, selector of investment products. That might not help the audience all that much because it sounds like a lot of work.
You're saying you still got to do your homework.
Yeah, obviously do your homework, but there is no substitute in any endeavor that's worthwhile. There is no substitute for hard work. And the more you familiarize yourself, the easier it becomes. I mean, we were just talking about James Clear's book, Atomic Habits, earlier today. And in it, he writes about a person who was trying to lose weight. And all he was trying to do was build the habit of going to the gym. He found the gym enormously intimidating. And depending on the type of gym you go to, that can be the case. But he took himself every day to the gym, and the hard work was parking the car, walking through the door. And he sat there for 5 minutes. He just had to be in the gym. He didn't have to lift a weight, didn't have to do anything until he stacked votes every day for himself as a person who goes to the gym. Of course, once he was there a few times, he begins the process of working out and training and getting fitter and what have you. And the same can be for any endeavor. If you want to learn, you can become the kind of person who takes an interest and starts to learn, whether that's picking up the FT and spending 5 minutes reading. There'll be an article amongst many that you might discard that will be interesting, or using a chat bot, or people are welcome to read our materials on our website. They have been designed to span our investor base, which is hedge fund managers, all the way down to their children who are just beginning to learn investing. So there are resources out there, and the best way to start is just to go in to read.
So, I mean, we often say to people with investing that that there's the paralysis of choice, and there's also this sort of nervousness. And we always say, listen, just pop £10 into something. Yeah, don't give it too much thought. Just do that, and then just leave it and see what happens, and experience the process. If you lose £10, that's not gonna change anything dramatically in your life for most people. So, just use that as a little experiment so that you can get comfortable with it. Would you say that can be true of this sort of dividend growth investing? That
I think for any strategy that resonates with the person who's trying to become an investor, I think it's a good idea to start with sums that they can tolerate losing, because there's a reasonable chance that may happen. But there isn't a substitute for beginning. Now, it's true that opening a brokerage account persists through the forms. They can seem a bit long and convoluted. If necessary, find a friend who's a bit more familiar. But there isn't a substitute for beginning. And a lot of people's philosophy will evolve over time as they get to learn more industries and more about themselves, more about what they're looking for in investment. People often think to themselves deep down, oh, I just want to be in the hottest thing that will change the world tomorrow, whether it's literally a gold explorer that may find something in the ground, or a biotech that doesn't yet have a product and it's got an idea and maybe they'll have a cure for something. But often the best place to start are things that are really simple, really familiar, one that you can quickly understand. You can put yourself in the position of somebody working there. Say, what's the business really doing? Maybe they even have stores. One of our large holdings is a company called Home Depot. It's the largest home improvement store in the United States. Most people can go to one. Or for a long time, we owned McDonald's, which we don't today. For most people, they can go to a McDonald's and they can kind of figure out what's going on. They can see the people there. They know the merchandise. They know the price point. They can get familiar. And then when they want to learn properly about considering investing in this, you can go on their website. You can download the annual report, or if that feels intimidating, you can start with the slide presentation for the latest earnings, but it looks familiar because we'll talk about sales of burgers and chips and Coke, and that's probably not as intimidating as high tech or pharmaceuticals where it might feel very foreign.
Yeah. So you just mentioned opening a brokerage account. So just for our listeners, just to be clear, are you referring to a brokerage account as a separate entity from an investment account?
I don't know the intricacies of how, say, a retail investor, I'm guessing in the UK, where most of the listeners are, goes about opening an account. So I don't want to advise or separate one way or another.
Okay. I mean, there are platforms in the UK where I think people brokerage and investing, we think of as two separate sort of things.
Okay.
One being that frequent sort of trading, and the other one being buy and hold.
Mm-hmm. Okay. So if we backtrack, without knowing the intricacies, the local intricacies, having a mechanism through which a person can go and make a purchase of a stock or an index or an ETF to begin, to watch it, to follow it, to read what they publish, which will typically be quarterly, to set up alerts if they know how to do that on Google, so that when there's an article about it, it maybe hits their inbox. And so they feel not like a speculator on a piece of paper, but like an owner of this business, which is why my suggestion is for that $10 or £10 that somebody is just exploring to try and learn, do it with something familiar that they can see, something that has maybe a nearby store or a product they use every day, so that the learning curve doesn't feel quite as steep.
So you're still thinking about this as a buy and hold endeavor rather than a rather than trading.
Yes, and our preferred time horizon, to borrow from Warren Buffett, is forever. Now, business is such that things don't necessarily last forever, though we do have companies that are flourishing today that have existed and flourished since the 1800s. Notwithstanding, as long as the company continues to deliver what we expect it to deliver, which is ultimately transmitted, if you want to use one proxy, through this dividend that is growing at a healthy rate, which makes it easier to stay the course, as long as that's continuing to be true, and all of our work indicates that will be true in the future, we're happy. We're always looking for new ideas, but we don't come up with that many good ideas in any given year. It's hard to find something that meets all these criteria. We run with about 120 criteria that we look for. So in any given year, we find sometimes none, but 2, 3, 4 new ideas. The bar for replacement is very, very high. Obviously, if there's a company that we've owned for 20 years, like in the case of MasterCard, we have had 20 years of knowledge accumulation. Whereas with something else, we might have only started learning it 3 or 4 years ago. Yes, we will research it vigorously and continue to work on it every single day. But the emotional component can actually take quite a long time.
Okay, so if I'm interested in getting into this, but I'm thinking, God, you know what? I've listened to this and I'd rather just piggyback on what you're doing. Talk me through it.
Go to our website. You can read our materials for the right kind of investor. Can have a meeting with somebody on our team to see if it's suitable. But in all of our materials, we write every single week. We write a short blurb about one of our companies, because what we do is every Friday we write to our investors what dividends we received this week, were they higher than this time last year? And if there's a dividend increase announcement during the week, we say by how much? And then we write 2, 3, sometimes 4 sentences about what makes this company special, those enduring insights. And week after week after week, our investors get to know what's really important in this business and that the dividends are rising at a healthy pace. And so while our unit price is rising quickly, that's great. And if it's not rising quickly, well, there are fundamental reasons why it should catch up to where the dividends are going over time. In all of our materials are all of our holdings. Now, we've already discussed a handful of them. We've discussed Visa MasterCard, we've discussed Home Depot, and we've discussed L'Oreal. These aren't things that are hidden out there that you'll never find. Many of these companies, the chance that the three of us have interacted with one or few of these companies today is very, very high.
Okay. So, I mean, if people are listening and they want to dip a toe into your educational waters and tap into some of these writings on the companies and how those dividends are going, Brianne, I imagine you'll be all over popping that website address in the comments of the podcast recording afterwards.
Yeah, definitely. We'll make sure we link to everything in the show notes. Jonathan, this has been such an interesting conversation. I feel like there's so much more we could dig into, but thank you so much for your insights. It's been, really, really insightful to kind of get a bit more grounding in how to look at dividends and really think about the companies not as something completely different or separate from what happens in life. These are things that you do interact with quite frequently. So I suppose that might help take a bit of the intimidation out of researching and thinking about it a bit more holistically.
Absolutely. And I think what's important for a person as a takeaway from all of this is to think about their habits for how they're going to behave when they invest. The same way for every other endeavor, you build habits around trying to achieve an outcome, and you can build the right habits when it comes to investing. That's what we're trying to do by educating, perpetuating this message. And thank you for being able to have this discussion today. We're trying to transmit this message that if you look at one proxy for how you're doing, and that proxy is delivering what you're looking for, that can create a habitual development in the person for how to stay the course, how to become an investor, how to get the compounding that everybody really wants to achieve. So thank you very much for your time. Great to be here.
Well, thank you. It's been absolutely fascinating hearing all about it. I really appreciate it. And thanks for speaking to us so late. I mean, you're based over in Sydney, so you've had to pull a long one today. But we really appreciate you taking the time.
Thank you very much. It was a pleasure.
Thank you so much for joining our Investing Insiders podcast. If you like the episode, please subscribe and leave us a 5-star review on your platform of choice. For the latest money news and deals, you can sign up to our weekly newsletter at investinginsiders.co.uk/newsletter-page. We've also got a suite of guides, tools, and calculators on our website at investinginsiders.co.uk. You can also keep up to date with us on TikTok, Instagram, and YouTube. Thanks for joining us, and we'll catch you in the next episode.